Welcome back, traders! In today's video, we're going to break down a very powerful price action setup that combines market structure, trend reversal, and breakout retest entries. By the end of this video, you'll understand exactly how to spot this setup and use it to catch high-probability trades. Let's dive right in. On this chart, we can see that the market started in a strong downtrend. Notice how price kept creating a sequence of lower highs and lower lows. This is the classic sign of bearish momentum. Every time price pushes down, it fails to break the previous high and instead makes a new lower high before falling again. But here's where things get interesting. As price continues downward, it forms a double bottom at a key swing low. This is a strong reversal signal because sellers tried twice to push the market lower, but they failed both times. That failure tells us that selling pressure is weakening and buyers are starting to step in. Next, we see an attempt at another lower high, but it fails. This is another clue that the downtrend is losing strength. Immediately after, price breaks out above the descending trend line. Now, many traders might jump in right at the breakout, but the smarter move is to wait for the retest. And that's exactly what happens. The market pulls back, retests the breakout level, and confirms it as new support. This retest is our entry signal. By entering here, we minimize risk while maximizing potential reward. The stop loss is placed just below the retest area, and our target is set at a favorable risk-to-reward ratio. In this example, it's a 1-to-4 RR, meaning for every dollar risked, we aim to make $4 in profit. This image explains a simple price action trading setup that revolves around the concepts of chart patterns, breakouts, and retests. At the very beginning of the chart, we see a double top formation, which is a bearish reversal pattern indicating that price failed to break above a resistance level twice. Once the second top is formed, the market breaks below the neckline, confirming the breakout. After the breakout, instead of entering immediately, traders wait for a retest entry, where price pulls back to test the broken support, now acting as resistance before continuing downward. As the trend progresses, we see another breakout and retest entry setup. Price breaks below another key support level, pulls back for confirmation, and then resumes its bearish move. This highlights the importance of retesting zones for safer entries. Later, the market shifts momentum by forming a double bottom, which is a bullish reversal pattern. Similar to the double top, this time buyers reject the lows twice, signaling that sellers are losing strength. After the double bottom, price breaks out above the neckline and again provides a retest entry opportunity. Traders enter long here, targeting higher price levels while keeping their stop loss below the retest zone. Overall, this chart teaches that the combination of double tops and double bottoms with breakout retest entries creates simple yet powerful price action setups. By waiting for confirmation through retests, traders avoid false breakouts and increase their chances of entering high-probability trades with controlled risk and strong reward potential. This image explains how to combine candlestick patterns, swing structure, and EMA retests to identify strong sell signals in trading. The chart starts with an uptrend, where price continues making higher highs. During this upward move, a bearish engulfing pattern appears. A bearish engulfing is when a large red candle completely covers or engulfs the previous blue candle, signaling strong selling pressure. This pattern gives the first sell signal. Shortly after, price forms a tweezer top, which is another bearish reversal pattern. A tweezer top occurs when two candles form almost identical highs, showing that buyers failed twice to push price higher. The combination of a bearish engulfing plus tweezer top strengthens the bearish reversal confirmation. Once selling pressure increases, price breaks below a previous swing low, signaling a possible end of the uptrend and the start of a reversal. The chart also shows an EMA retest. Price pulls back to retest the exponential moving average after the breakout. This retest confirms that the EMA, which was acting as support in the uptrend, has now turned into resistance in the downtrend. The final sell entry comes at the point where price retests the EMA and fails to break above it. From there, the market continues strongly downward, confirming the reversal. In summary, this image teaches that using candlestick patterns like bearish engulfing and tweezer top, combined with a swing break and EMA retest, provides a high-probability trading strategy for catching reversals early and entering sell trades with confidence. This chart explains the concept of price action by focusing on how candlestick structures, especially wicks, show market rejection levels. Each candlestick has 4 key components: the open, the close, the body, and the wicks, upper wick and lower wick. The body represents the range between the opening and closing price, while the wicks show how far price moved during the candle before being rejected. In the chart, we can see that when candles form long upper wicks, it means the market tried to push higher, but sellers rejected those prices, forcing the candle to close lower. This signals potential resistance and bearish pressure. On the other hand, when candles form long lower wicks, it means sellers tried to push the market down, but buyers stepped in and rejected lower prices, causing the candle to close higher. This signals support and bullish pressure. The image also highlights that wicks signify rejection, and these rejection points often act as key support and resistance levels in the future. For example, when price repeatedly rejects a certain level at the top, it shows strong resistance, while repeated rejection at the bottom signals strong support. In short, this setup teaches traders to pay close attention not just to where a candle opens and closes, but also to the wicks, because they reveal hidden buying or selling pressure and help identify strong reversal zones in the market. The M pattern, also known as the double top pattern, is one of the most reliable bearish reversal structures in price action trading, often seen after a strong bullish move. It signals that the market's upward momentum is weakening and sellers are preparing to take control. The pattern starts with a strong upward rally where price climbs and reaches a key resistance area, forming the first peak called top 1. At this point, buying power slows down, sellers step in, and the market pulls back to a nearby support level, which also acts as the neckline of the pattern. This initial decline does not yet confirm a reversal. It simply shows temporary profit-taking or resistance pressure. After touching support, the market usually makes a second upward attempt. Price climbs again, but when it reaches the same resistance zone as before, it fails to break higher and forms the second peak, or top 2. This double rejection is a strong sign of market weakness because it confirms that buyers do not have enough strength to push price beyond the resistance. From here, sellers begin to dominate, and price starts falling back toward the neckline. The most critical stage of the pattern is when the market breaks below the neckline. This breakdown confirms that support has failed and that bearish momentum is now in full control. Traders typically use 2 possible entry strategies: entering immediately at the breakdown point for a more aggressive approach, or waiting for a retest of the neckline, where broken support turns into resistance, for a safer and more confirmed entry. For proper risk management, a stop loss is usually placed just above top 2, since a move above that level would invalidate the bearish setup. The profit target is measured using the vertical distance between the neckline and the peaks, top 1 and top 2. This height is then projected downward from the neckline, giving a clear 100% target level. The W pattern, also known as the double bottom pattern, which is a bullish reversal formation in price action trading. It signals the end of a downtrend and the beginning of a potential uptrend. The pattern begins with a strong downward move where price breaks through a support level, showing sellers in full control. However, instead of continuing lower, price finds a bottom and forms the first low. At this level, candlestick signals like a hammer often appear, indicating buying interest and rejection of lower prices. From here, price bounces upward but gets rejected at a resistance level, forming a temporary peak before dropping again. During this second decline, sellers try to push price lower, but the market finds support near the same level as the first bottom. This forms the second low, creating the characteristic W shape. The second rejection of support confirms that sellers are weakening and buyers are stepping back in with strength. The key confirmation of the W pattern happens when price breaks above the resistance neckline. This breakout gives the entry signal for long trades. Traders typically place a stop loss just below the second bottom to protect against false breakouts. While the profit target is measured by taking the height of the pattern from the support level to the neckline and projecting it upward, often aiming for a 100% target level. In short, The W pattern represents two failed attempts by sellers to break support, followed by a breakout above resistance. It is a powerful bullish reversal setup that offers traders a clear entry, stop loss, and target level, making it one of the most effective price action patterns to trade at the end of a downtrend. This chart illustrates a technical analysis framework that combines concepts of accumulation, breaker blocks, demand zones, order blocks, support, and resistance to identify high-probability trading entries. The process begins with accumulation, where the market consolidates in a sideways range, building liquidity and preparing for a breakout. After this phase, price creates a spring or false move downward to trap sellers, followed by a sharp breakout to the upside. This breakout shifts market structure and confirms bullish intent. Next, we see the formation of a breaker block. This is a zone where price retests the breakout area. Traders often look for an entry in this zone, as it acts as a strong support after the breakout. Following this, the market establishes a demand zone, where buyers step in again, pushing the price higher. As the uptrend continues, price reacts to multiple resistance levels, but instead of reversing, these resistances turn into support zones after breakouts. Each successful retest of these zones creates a bullish order block, which represents institutional buying areas where smart money has entered. These blocks are key zones for traders to find new entries, as price often bounces strongly from them. The chart shows how this process repeats in cycles. Accumulation leads to breakout. Breaker block forms and offers an entry. Demand zone is established for another push upward. Resistance turns into support, creating bullish order blocks. Price continues trending upward with new entry opportunities at each retest. This chart demonstrates how professional traders use market structure shifts, breaker blocks, demand zones, and bullish order blocks to enter trades in line with the trend. Instead of chasing price, they wait for breakouts, retests, and confirmations at key levels, ensuring entries with strong probability, controlled risk, and maximum reward. This chart shows a bearish technical analysis setup that combines multiple price action signals to confirm a strong downtrend. The pattern begins with a flag formation. After a sharp drop, the price consolidates in a small upward-sloping channel called a flag. This usually indicates a temporary pause before the trend continues downward. At the same time, a bearish trend line is drawn across the highs, showing consistent downward pressure from sellers. Next, the price reaches a significant zone, a key support-turned-resistance level. Here, the market forms a double top pattern. The first top and second top show that buyers failed to break above resistance. This double top is a classic reversal signal, suggesting a shift from bullish to bearish momentum. The confirmation comes with a bearish engulfing candlestick, where a large red candle fully covers the previous green candle. This strong bearish candlestick pattern signals heavy selling pressure. Once this happens, price breaks below the support zone and starts a strong move down. Together, the flag, bearish trend line, significant zone, double top, and bearish engulfing create a high-probability bearish setup. Each element reinforces the next, giving traders confidence that the market will continue its downward trend. In short, this chart shows how multiple bearish signals align, leading to a strong market drop, an excellent example of confluence trading in technical analysis. This chart explains the distribution phase in technical analysis, which usually occurs after a strong uptrend and signals a potential bearish reversal. At the beginning, the chart shows a clear uptrend where price keeps making higher highs, HH, and higher lows, HL. This indicates strong bullish momentum. However, the trend weakens when a new high fails, meaning price is unable to continue making higher highs. This failure is often an early warning sign that buying power is losing strength. Next comes the break, where the market fails to hold its bullish structure and starts moving sideways. This sideways phase is called the distribution zone, where big players, smart money, or institutions offload their positions while retail traders continue to buy, thinking the uptrend will resume. The distribution is marked by consolidation, a range-bound movement with no clear direction. The chart also highlights a double top pattern, which is a bearish reversal signal showing two failed attempts to push higher. After this, consolidation continues, but once sellers take control, price breaks down from the distribution zone and begins a strong move down. The distribution phase represents the market's transition from bullish to bearish. It's where smart money sells at the top while unsuspecting traders keep buying. Once distribution ends, the breakdown leads to a sharp decline, confirming the reversal. This pattern is crucial for traders to spot because entering long positions during distribution can lead to heavy losses, while correctly identifying it can open profitable short opportunities.